It turns out that you guys are not satisfied with having merely a basic knowledge of employee stock option plans, and so you asked questions, and I have collated those questions and I'm about to answer them because who am I to deny your request? Anyway guys, this is gonna be frequently asked questions and their answers on employee stock option plans. Hi guys, I'm Noah Grace Agokore, a corporate and tech lawyer passionate about helping founders and startups just like yourself start, grow, and scale their businesses. So you guys have written your questions, you've asked your questions, and I'm answering them today. In fact, I wrote them all down in my notes, so I'm answering them today. Question number 1. Hi Norma, can the option to purchase shares be exercised before vesting begins, or must the vesting schedule be exhausted before one can exercise the option to purchase shares and become a shareholder? The simple answer, no. Options cannot vest, or you can't become a shareholder, a complete true shareholder in that company, until the entire time passes, aka the shares completely vest in you. And that means the passage of both the cliff period and the 3 or 4 year vesting schedule. The time allocated or allotted in the vesting schedule has to pass first before you can become a full shareholder in the company, because during the vesting schedule the shares vest in portions, either monthly portions or quarterly portions, but the point is it vests in portions, and throughout that month or throughout that quarter until the time is exhausted, and you can't have your full shares until the time elapses. So no, you cannot become a shareholder until that shares or until that vesting schedule is completely elapsed. Question 2. When a share is exercised, what does the option holder get? ESOP seems like a concept that favors the company more than the employee. Is it true? What does the employee actually get from an ESOP plan? How does the employee make money from this, seeing as it's meant to serve as an incentive used by companies to lure in high-value employees in place of outright cash or payment? Stunning question. Now, as an employee, when you are the beneficiary of an ESOP plan, there are several ways you can make money. But your increase or your profit in that company is directly tied to and dependent upon how well that company does in the market. If the company tanks, so do your shares. If the company does really, really well, so do your shares. But to answer your question directly, how can an employee make money from an employee stock option plan, or what is the benefit to them? Well, benefit number 1 is that you become a co-owner of that company. You own that company, and so therefore you can make decisions for and on behalf of that company, depending again on the terms and conditions of the general ESOP policy. But typically, as a shareholder / co-owner in the company, you have certain rights, and those rights automatically accrue to you. Another way you can make money is capital gains. Again, if the company does well and makes money in the market, so do your shares. So does the value of your shares. As the company increases in its revenue and market cap, so do your shares and its value. Number 3, how you can make money. Well, when the company either IPOs, acquires another company, is acquired by another company, or otherwise restructures itself, the revenue that comes in from that, you are entitled to a percentage of it as a shareholder based on the number of shares that you own in the company. It might be a lot, it might not be a lot, depending on the number of shares that you own in the company. Another way for you to make money is through dividends. Now, when the company declares dividends are declared annually. Well, not every year, it depends again on the company and its plan. But when it does declare dividend, you are entitled to an amount of dividend based on the shares that you own. Another way for you to earn, maybe not money immediately, is through career growth and your reputation. There are some certain places, especially in places like Silicon Valley, where being a part of startup with a success story, that you were an active founding ESOP member, can give you some kind of street cred, and that can boost your career trajectory in ways that money now does not solve or cannot give you. So those are some of the ways whereby an employee can benefit or make money from an ESOP. Again, remember, as the company does good, so do your shares. If the company tanks, so do your shares. But 9 times out of 10, I can see how people would think that ESOP favors the company, and sometimes rightly so, because ESOP saves the company time, saves the company instant cash. So instead of paying you that instant cash that you would need as a high paying or a high earning employee, the company reserves those funds for its operations. But when done right, ESOPs can favor you as well, as I've listed in the many ways by which you can make money from it. Question number 3. Norma, I need a legal checklist for setting up an employee stock option plan in my startup. Okay, there are several phases where setting up an ESOP in your company. Phase 1 is ideation, plan creation, strategic planning. In this stage, you have to identify what pool or what options or how many percent of that pool you want to set aside for your shares or for the ESOP plan. You have to review your capital structure. Does your capital account for it? Is it accounted for in your CSC document if you're in Nigeria? If it doesn't, will you be willing to upgrade your share capital to account for it and thereby upgrade your cap table as well? Does this align with your business goals? These are some of the questions that you ask and answer within the strategic planning phase. The next phase is the corporate authorization phase. In this phase, you have to make sure that all stakeholders in the company, and by stakeholders I mean the board of directors, the other shareholders, etc., they are in agreement with this plan to restrict a specific option or a specific pool of your shares for an ESOP. This is also the stage whereby if you need to update your CSC documents if the current share capital or the current share structure does not account for ESOP. This is also the stage where you get your board resolution and other such corporate authorization documents. Step 3 or stage 3 in your legal checklist is to start drafting your documents. So from your general ESOP policy to your letters of grant to your exercise notice, option certificate, board resolution, etc. Now is the time to draft them. Step 4 is your regulatory compliance. Are you in compliance with the Corporate Affairs Commission and the Companies and Allied Matters Act, aka CAMA? Are you in compliance with tax? What are the tax obligations? Who pays taxes on the shares that are being bought or that are being sold? Who pays the taxes on them? Are you in compliance with the SEC rules? Because again, your shares in your company is an asset and you are hereby giving it to employees. Are you in compliance with the SEC rules? If you even want to IPO, are you in compliance with the SEC rules? After you have made sure that regulatory compliance is good to go, the next step is to take care of your employee communications. Are your employees aware of what they are entering into? Are they in agreement with all the terms? Do they even understand the terms and how they stand to benefit from them? Make sure. Step 6 now is you need to plan an exit and liquidity plan. What happens if your employee terminates, if your employee resigns before her stock options fully vest? What happens if they are terminated? What happens if the company is acquired or merges or IPOs? What happens if they just want their money? You need to plan for all of that. And the last step, I think, in your legal checklist is something to track the implementation of your employee stock option plans and policies. So whether that be a performance appraisal, KPIs, or whether that be anything really that your company can use to track it, whether it's through a register of members, register of ESOP beneficiaries, whatever. It is dependent on the company and its choice to decide on what it wants or how it wants to track the implementation of the ESOP. But tracking is very, very important because it lets you know who has taken what, who has exercised what, whose vesting is still counting, and on it goes. Question 4. What is a deed of accession? Does an option holder need to exercise one? No. A deed of accession is a document that accedes to a futuristic one. Let me give you a perfect example. If your employees or beneficiaries of your ESOP policy sign a general ESOP policy, and in the future the company collates all of the shareholders and does a general shareholders agreement, then the general ESOP policy has to accede to, or basically hand over its power to, the shareholders agreement, thereby saying that the shareholders agreement will now cover for the ESOP, general ESOP policy, and all questions comment bindingness, if that's a word, will now be based on the terms and the conditions as stated in the new shareholders agreement. So a deed of accession is something that is basically handing over power to you, or ceding your rights to something in the future. And no, you do not need to sign one, or you do not need to execute one if the company does not have such a futuristic agreement like a shareholders agreement or something like that. If the general ESOP policy suffices, then there's no need for a deed of accession. Question 5. Do I need an option certificate when I have a letter of grant? They basically say the same thing. Well, no, you don't need an option certificate. Is not compulsory if you have a letter of grant, especially if you also have an exercise notice, because both those agreements, the letter of grant and the exercise notice, can suffice for the option agreement. So it's not compulsory to have them. It's just a nice to have for better documentation in your company. Question 6. Norma, under ESOPs, what is the difference between a cancellation and a forfeiture of shares? Interesting one. Forfeiture and cancellation of shares under the context of ESOPs, both of them mean or refer to a situation where an employee stands to lose his shares. Now, how that share is being lost, or how that stock option is being lost, is the key difference between a forfeiture and a cancellation. Now, a cancellation is basically a revocation of your shares, basically, by the company or the board, where something has happened and they have entirely annulled or cancelled or revoked your rights to, or your entitlement to, those shares. Simple as that. A forfeiture, however, is where you didn't meet certain conditions and then the remaining unvested shares are forfeited. You no longer have rights to them because you did not meet these rights and conditions that were set forth at the beginning of your ESOP journey. Question 7. Is there anything else that is important to learn about ESOPs that hasn't been covered in the previous videos or these FAQs? I wrote this question just for you guys. Okay, some of the questions or some of the things that we didn't previously cover in the first video or in these FAQs that you guys have so graciously asked are: number 1, what are ESOP accounting and tax implications? Well, because money is moving hands, so by money moving hands, I mean when the employee is about to exercise their option to own shares in the company, they obviously would pay for those shares either at the fair market value or at the strike or exercise price. That is a discounted price. That means money is moving hand to the company. So when the company receives that amount, do they pay taxes on it? When the company does then make money, or when the shares makes money, either they're being sold for a profit or they're declaring dividend, or whatever it is that is being returned back to the employee with profit, are there taxes on that amount, and who pays those taxes? Yes, there are taxes on the amount, and it's typically always the recipient that pays the taxes on the money, depending on the terms of the agreement. Terms of the agreement are very important because they'll tell you upon whom the responsibility to pay those taxes lie, so that it avoids all confusions. But mostly there are capital gains tax. So capital gains are, again, your capital has gained something, so therefore you are taxed on the gain that your capital made. So if you bought shares, exercise your stock option rights in a company, and you bought shares, and sometime in the future those shares have made more money for you and you are receiving the money back, the extra that those shares made, you are taxable on that, and so therefore you pay capital gains tax on that. The point is to always clarify tax compliance and tax treatment in any ESOP plan, just so that you understand who is paying what, because ESOPs typically last for minimum of 3, 4, 5 years, and so you don't want your communication to get lost in transit and then you start arguing back and forth as to who is meant to pay what taxes. That's not right. Are there any regulations to comply with in the implementation of ESOPs? Well, not specifically, no. There are a handful of laws and regulations that you do need to comply with on a general basis, such as your CAMA, your Investment and Securities Act, your Tax Act. Well, there are many tax acts, but the various tax acts, and all of that, again, depending on your industry. But there is no one specific law that defines ESOPs and how ESOPs should be managed. Typically, when there is a dispute on ESOPs, it is before the dispute resolving body, whether that's a court or an arbitral tribunal, before mediators or whoever, to decide, and it's based on your documentation. That's why it's very, very important that an ESOP policy's documentation be done right. And the last thing that you need to know about ESOPs that was not previously covered in the video, in the first video, or in these FAQs, are the communication and training of employees. 9 times out of 10, I've seen this over and over again in my experience as a corporate and tech lawyer. Most employees do not understand ESOPs. Heck, most startups themselves don't even understand ESOPs. So it's very, very important that both the startup, the person that is offering their shares, and the person that is receiving their shares, aka the employees or the key hires, it is important, it is crucial that they understand what ESOPs are and how they stand to gain or benefit from it. Otherwise, the entire thing collapses. And so guys, that brings us to the end of our frequently asked questions and answers on employee stock option plans. Thank you so much for bringing in your questions. I really, really appreciate the engagement. And I was very happy to do a video answering all of those questions. Now, if you found this video valuable, please don't forget to like it so that it is shared to many more amazing people such as yourself. Until next time, guys. Bye.